the balance growing as well.
Okay. And the other thing I'm going to do is go back to the bankruptcy attorney. I know they talked to a bankruptcy attorney, and see if they've got notes on why did you go this route? What did you think was going to happen?
Mhm. Yeah.
Because I
I
got,
would be
yeah.
if you're open to it and they're open to me seeing it, I would be more than happy to look at the report and see what my advice would be.
Okay.
Um,
Yeah.
and I'll introduce myself here in a second. You'll know why I'm saying that to you here in a minute. Who I am.
Yeah.
So it makes sense. Hi, Mark. Who you got with
Okay.
you?
All right. I
Hold
got
you're
the
on mute.
live going. So, hey,
Well,
Mark, you're on mute, by the way.
we're gonna wait till Mark gets unmuted so I can find out who he's got in his lap there.
There we go. Yes.
Hi, who is that?
Oh, this is Cleo. Hey,
Cleo.
Cleo.
Hi, Cleo.
Check out these paws. Oh, there we go.
Those are some big balls. They look like hands.
7 on each one. And her and Gizmo are trying to push me out of my office chair right now. So that's why I'm moving them around. How have you guys been?
Very good.
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 Long time no see.
It has been a while.
Okay, I've finally got everything going. 20 years later. Okay, so we are live. We might have some people join us throughout as well. And I look really tall. Let's just
You are really tall.
there.
I'm short.
I look really
go.
big.
You look really big, yes.
No, I'm smaller.
Uh,
Okay, we'll go ahead and we can dive into everything.
wonderful.
So every week we do a live. 1 week on is for consumers, and then the other week, the opposing week, is for professionals. You can see all the lives on our Facebook. They're scheduled through May at this point. And we'll be posting probably in March. I'll post another 3 to 4 months up as well. If you ever have suggestions on topics, let us know. We are more than open to suggestions. Otherwise, we have to come up with everything we think you want to know about.
Howard?
With that being said, I'm going to share my screen. Allie's going to help make sure I share the correct screen because I never do. And then we're going to go ahead and get started. Okay, so let's try. I think if I do it this way.
Nope. Yes.
No?
There you go.
Is it showing presenter view or the correct view?
The correct
Full
view.
screen. You're full screen.
Cool. Okay, perfect. Now where are you guys? There you are. Yay. Okay. So today our topic is 5 credit tips for lending professionals. And there's going to be some spicy information in here too that we'll talk about in the beginning. Allie, let's go ahead and we'll start with you introducing yourself, and then I will introduce myself next.
All right. So I'm Alicia Alt. I go by Allie. That's why she's calling me Allie, and I'm saying I'm Alicia Alt. But I am a credit expert. I've been doing this for 20 years now. My background is in lending and real estate. So that's why I was talking about, hey, if you want to send me that report, I'll look at it with the lender's eyes and the credit expert eyes. But yeah, I've been doing it for 20 years. And what happened in the 20 years is I originally was a teacher. That's what I started out my career in, and went into long story about how I got into the lending world, but I did. And I didn't know anything about it, but I learned really quickly. And one of the things I learned really super quick back in that time, it was big business, right? It wasn't slow. It was very big when I got in. And so if a loan officer could not approve a client due to credit or debt to income ratios, that person didn't even get a phone call back. It was like, kind of cutthroat like that. So I was managing the mortgage company, and I decided to take it upon myself that I would call those people and see if I could figure out what their credit issues were, because they would cry and they didn't know what to do. They're like, everyone's denying me, but nobody tells us what to do. And so I took it upon myself to figure that whole process out. So I did that for free for clients for 2 years, so I could figure out the system and create an actual algorithm that works for the mortgage lending space. So with that, years and years went by, refined that, added on to that. And now we have joining forces with Ivory, who will introduce herself. We created Credit Score Pro because we wanted to be able to bring that credit expertise to everyone at a very low cost. And so we were able to do that through using software and AI. And we'll get into that a little bit later. But Ivory, would you like to introduce yourself now?
Sure. So my name's Ivory Becker. Been in the industry I just stopped counting at 15 years. I've never updated this, so should probably look back and see if that number needs to change. But my background's in regulatory compliance. So I used to deal with the banks, in between the banks and the regulators, making sure we dealt with the fallout from the financial crisis properly, and understanding essentially the laws and regulations around default. And then ended up opening a credit repair business after a brief stint in financial planning. Allie and I met each other randomly and realized our views on pretty much everything credit related were pretty aligned. From there, we were able to combine our experiences that were really complementary in putting together a really cool product that she talked a little bit about. And we'll share details later. But from here, we like to do these lives every Thursday just because everything's changing a lot and quickly. We want to make sure we provide a solid support system to not only consumers, but those in the lending space. That way we can make sure we're positively influencing consumers as well as you. Feel free during this, just unmute yourself, ask questions. We prefer it to be interactive. The whole point is for you to be able to take something away from it. If you prefer not to speak, you can use the chat too. If we get questions through the live, through YouTube or through Facebook, we'll answer the questions there as well during today. So with that being said, I thought I'd start with some fun statistics. So 37% of adults in the US have a credit score below 700, and 60 million Americans have a credit score below 670. So these are the statistics from what we've seen over the last several years. What we're going to transition to talking about is some very recent changes that we're seeing in the industry or in general when we look at the average consumer. Pulling this data from both VantageScore and from FICO. So let's just dive right into it. So the type of consumer we're seeing now is changing. You all in your day-to-day business have probably started to see this shift happen. So we've had people who have purchased homes, they had that great interest rate, they're really staying put. The type of people looking to buy now look a little bit different than what we saw in the last couple of years. And on top of that, younger borrowers are looking very different than borrowers in prior generations. And we're going to look at what those numbers look like. Anything you want to add, Allie?
No, I think that's great.
Okay, so let's look at the data. And I'll try not to make this too dry. Credit card debt. So we're going to look at how credit card debt is changing. So specifically, this is focused on Q4 of 2023, and all of this data is coming from FICO. So credit card usage is a key indicator of consumer finance and consumer behavior. It directly impacts sentiment as well, right? And it's used often to forecast. Credit card balances increased higher than year-over-year inflation. So inflation was at 3.4% in December 2023, based on the numbers were provided, and credit card debt increased 4.7%. So we're seeing people spend more than the pace of inflation. And usage before COVID was less than 50% of credit cards were active. So if you had 4 credit cards, the average consumer was using 2 out of the 4 credit cards, to put that in perspective. And we're starting to see that steadily rise and steadily increase. And beyond that, people are also paying less of their balance off. So they're using more of their credit cards and paying less of their balance off. So that being said, we're starting to see a lot more consumer debt than we've seen in quite a while. I'll just give you an example. Goldman Sachs is predicting that their credit card losses are going to peak at the end of 2024 and beginning in 2025. So that's a long duration. Essentially, they're anticipating to see this path continue. and hit a point to where they're going to see losses starting later at the end of this year or early 2025.
Yeah, and if you haven't noticed, the credit card interest rates are growing extremely high. I'm seeing right now like 34.99% interest rates. I thought 29.99 was high. Now we're some credit cards at 34.99. And I think that's because the credit card companies are seeing what Ivory's talking about with this default happening. So they're trying to recoup. But that also goes into the issue with, when we say the consumer is not paying down the balances, a lot of that's because the interest is so high. When they make that payment, they're barely hitting any principal, right? So it's taking a lot longer to pay down balance.
That's
Yeah.
what I was. That's what I was going to ask. Are they predicting this loss towards the end of 2025 because of defaults?
Right. Yeah. So they're looking at the aging delinquencies, which will eventually lead to charge-offs, potentially.
Sure.
Yeah. So, and we're also seeing a lot of people, instead of using credit cards for big purchases, using it for day-to-day needs, right? Just to get by.
Yeah, exactly.
And actually, delinquencies is exactly what we're going to talk about next. So perfect segue. So with the delinquencies, we're seeing a rise across the major credit tiers. Now I want to describe what those credit tiers are. So you'll see on the screen, it says subprime, near prime, prime, and super prime. That's just putting consumers into different categories. So Vantage themselves says anyone with a 300 to 600 credit score is considered subprime. Near prime is going to be 601 to 660. Prime is going to be 661 to 780, and super prime, so those really great scores, 781 to 850. Okay. So there was a 1% contraction in the size of the prime tier. So really what we saw is less people fitting that prime category and shifting into other spaces. We did see some shift up to super prime. So some people's scores did get better, but a lot of people also shifted downwards, right? They're no longer in that good credit category. And the concern is with the increase in credit card debt, we may see more people shift downward as well. And then we're also seeing a decreased origination. So just across all types of lending, we're seeing less lending happen to consumers.
So can I ask a quick question in regards to this?
Yeah.
So, I don't know what it is. Whatever the online thing is that sends me an email 3 times a week telling me what my credit score is and so on and so forth. It seems like as I go forward and pay down my credit cards, I get these little notices that say, oh, your credit score has changed.
Mm-hmm.
And it drops like 15 points.
Mm-hmm.
Why would that be?
So I think I can answer this question. It might not be
Okay.
Right answer, but if you're using, there's, obviously a couple of those free credit monitoring sites. One of them specifically being Credit Karma. We will oftentimes see an improvement in the person's credit like that. You pay down a credit card and balance, or the credit score goes down. If that's what you're using and you look at where they have, green is good, gray is neutral, red is bad. If you're seeing all green, I can assure you, you did not get a credit score drop from paying that down.
Okay.
And you'll see like a little note, even Credit Karma is aware of this issue. It'll say something like, sometimes you'll see a drop and there's really not a good explanation. They literally say that on there. So you cannot drop your score by paying down credit card debt.
Okay, so they're like the Zillow of credit card reporting.
There you go. That's a good way to put it.
The A is for accuracy, right? Okay.
Yeah.
Yeah, I mean, it's also possible something else has caused it to drop, something non-correlated, and it's coincidental. But if you're seeing it consistently, then it doesn't make sense to me.
Well, it's weird because, again, I get the little note, and Credit Karma is one of them. And what's the other one that starts with an E?
Are you thinking Experience website directly?
Experience. Yeah. Both of them will do the same thing. Mm-hmm. And so it seems like right after I pay off big chunks of my rolling credit, and I don't have very much credit at all anyway. Okay. I just don't carry rolling credit, and I own my cars and I own my house and everything else. But so it seems like as soon as I pay it, about 3 days later, I'll get a thing and I'm all excited going, oh, yay, it's going to go up. And then when I look at it, it went down. And then like a week later, it'll tick up a little bit and so on. So I'm just kind of wondering if there's any truth to it at all.
You may have a thinner credit profile as well, causing some more volatility in your credit score if you
Okay.
don't have a lot of information on your credit report. So small changes can cause big swings. Kind of similar like to if you think about volatility on the stock market, but it seems to all write itself out. It sounds like for you. I don't know. I'd have to look more
Sure.
at what's
The other
going
thing
on.
that I was thinking about as you were talking, so if I pay my credit card payment today, it could literally take 30 days before that actually updates that I made that payment.
Mhm.
So maybe you're seeing that drop because it's showing a higher utilization.
True.
Then you start to see it improve in the next few weeks where now they're showing, updating that payment and that balance. That could be part of it as well.
Okay. Then I'll wait a couple of weeks and check it and see if that's what's happening.
Yeah.
Okay. Thank you.
Yeah. Okay, delinquencies. So in the next slide, I'm going to show you some graphs. So this information on here makes sense. It's just way too much to put on one view. Okay, so delinquencies across all, what we're going to look at in the next page is the delinquencies across all credit types in 2024. So that's January 2024. So it's looking at all types of debt. So as we started the year, we're seeing more delinquencies. The late payments are, and just a reminder, it's looking at anything that's 30 days past due and greater. That's when it's impacting your credit. So in the subprime Vantage tier, 21% of all auto loan balances, 27% of all mortgage balances, and 15% of all personal loan balances. And then lastly, 18% of all credit card balances are reporting as 30 days past due. That's crazy.
Big increase.
So just in the subprime tier, that's a huge percentage. So said differently, 1 in 5 subprime auto loans, 1 in 4 subprime mortgages are at least 30 days past due. So it's pretty concerning. If we want to do a comparison, financial crisis, we had during the financial crisis, delinquency rate peaked at 10.7%. And the last full, like everyone, not just looking at subprime data we got on delinquency rate is it's currently at 6.3%. So it's just over half of what it was during the financial crisis, but we're early on into potentially what we may see over the course of the next year or so. So just something to consider, something I don't think a lot of people are looking at or talking about right now. And all of this impacts what we're going to be doing in the lending space over the next few years. So one of the other things we wanted to do is break it out by generations, really looking at what's the impact on the different generations. So 1% of balances by boomers are delinquent versus 1.53% Gen X, 1.75% for millennials, and basically 2% for Gen Z. So younger borrowers are twice as likely to be past due as their grandparents, right?
So what do you attribute that to?
I mean, there's a lot of things we can attribute it to. Everything's more expensive for people right now. I mean, basic things like you go to the store, get eggs, it's not affordable, and the income we're getting, right? Our
Sure.
wages are not keeping up with the cost of living, right? Inflation's outpacing wages. So to live in the same capacity as you used to, it takes way more money.
Sure.
People aren't making that money and they have a lot higher debt too on top of it.
Yeah, I think there's like layers, and you think about the Gen
Yeah.
Zs, I call them, they're obsessed with the new, right? So if the new iPhone comes out, they need that. If a new streaming service comes out, they need that. So they have all these things. And I'm thinking of like my older children, they have every streaming service you can think of, right? They have the iPhone and the iWatch, and when that updates, they need that one, right? So I think they're addicted to the new. So they are getting in more debt than the boomers and the Gen X, where we're more grounded in not having necessarily to have all the new stuff, if that makes sense. And
yeah, I think that older people probably don't chase shiny things as much as younger people do.
Yeah. Or we do, but they're bigger, funner things. And we have
Yeah,
the money to
mine
support it.
mine happen to be like month-long trips to Europe, but yeah,
Right.
but I also pay cash with them. So, you know,
Right, but
what about,
like
what are
things
your
have
thoughts?
been paid down too, right? Because people were able to buy homes at a lower price point before too, and you're able to kind of move up a little bit faster because you could get that appreciation from your properties. There's all sorts of things that go into it, right?
Nope, I agree.
So
I think they're in a hard generation,
yeah,
really hard. I know I wouldn't want to be there.
yeah.
I
What
just
were you
wouldn't
gonna
want to
say
hang
though?
out with their friends,
Right.
but I'm old, so
So if we look at the graphs on the page too, essentially, just to summarize it, Gen X is 50% higher delinquencies than boomers. Millennials are 75% higher delinquencies than boomers, and Gen Z is over 100% more delinquencies than boomers based on outstanding balances with delinquencies. So this is only based on balances and delinquencies. We don't have actual number of people, if that makes sense. So it's kind of a rough way to look at the data.
is it
Mhm.
possible that there are college loans that are lumped into these numbers?
So these loans, these do not have college loans built into it.
Okay,
So it's just credit cards, auto loans, personal loans, and mortgages. So
That
no.
would be an
bottle
interesting
service
category.
in Las Vegas and, you know, that kind of stuff.
Okay, so let's look at mortgages. So for mortgages, percentage of consumers that opened new mortgage in January 2021 was 1%. 2022, it decreased a bit to 0.7%. And then in 2023, in 2024, it was 0.2% of what consumers were showing. So 1/5 of the prior rates. So a lot less people going to get mortgages. And then people in subprime decreased even more, right? Less people in the subprime category trying to get mortgages. What else do we want to take from this?
What you mean, super prime? There's less people in the super prime getting mortgages, right?
Yes,
Than-
sorry,
yeah.
yes, super prime, not subprime.
Yeah,
Because they're
which makes
staying
a lot of
put, right?
Yeah, they're staying put.
So
So I see prime data, I see super prime. Oh, subprime. There we go. Okay.
yeah.
All right. Still, I
Yeah,
mean,
so Vantage kind of breaks everyone into categories and then does comparisons on the different type of people within those categories.
Well, we've got interest rates that are going to play into that for sure.
Absolutely.
And it shut everything down like as of like, you know, maybe August of last year. And people were still remembering, you know, the great rates that they got in 2021 and so on and so forth. So,
Yeah.
and I don't,
And
for
holding
those
on,
of you,
hoping they're coming back.
yeah. So for people who don't know on here, I'm a real estate agent, and that's been a big challenge for all of us for almost a year now. So yeah.
Absolutely. So why do all these stats matter, right? Looking at that mundane data. So figures are suggesting that the bumping up the applicants from subprime to near prime is going to double the likelihood that they'll be approved for a mortgage. Why is that so important? We're here talking about credit, right? If we're able to just marginally increase their scores based on the data we see, the likelihood of them to get approved for a mortgage is substantially higher.
yeah. And can we go back to the screen just real quickly of what that looks like if we look from subprime to near prime with that marginal differences in credit score that they would need to get to?
Oh, yeah, right here.
Yeah. So that's 601 to 660 range puts them into buying power. Yeah, I would agree. I mean, and that also gets them to down payment assistance and things like that once it gets that 640, 660 range. So, I mean, that's the goal here with this presentation is how do we get people from out of that subprime to that near prime so we can open up the floodgates again and start doing loans. And I think we haven't said this yet, but those borrowers who are out there looking to get a home loan are the ones that are in that subprime. most of them, need to get into that near prime, but they are not very sensitive to the interest rates. They don't really care that they're higher interest rates because they have high interest rates on everything they get already.
Mhm.
So 7% is good when their car interest rate is 25%. Right.
Yeah.
So I think that's important to note that if we can help these people, and that's a big mission for Ivory and I, and why we do these seminars and try to get the word out, is if we can get people out of that subprime range, and we're not talking about a lot to make that happen, then we give them so much buying power. And Mark, you're a real estate agent, so you know the benefits of someone having a home, growing equity, and what they can do with that to impact and improve their life, right? It's phenomenal. And I can attest to my own story about, 21 years old buying my first house and what that was able to do to my savings and my finances throughout my life.
Mhm.
And growth. And
It's
I think
amazing the foundation that simply buying a home, something simple, small, doesn't have to be, mansion in Ashley Heights or anything, but just a simple small home. The foundation that can build underneath somebody at a young age. I wish we could get that message out more. So
Right. Right.
Help us.
Exactly.
help us.
That
We
is a
can do
big
this as a
difference
team.
that I see in the marketplace. When I started in 1989 in Orange County, the first time home buyers were buying condos. They just knew it. They all expected to have to move up in multiple steps, and somehow we lost that. Yeah.
Interesting. Yeah, that's an interesting point.
very true.
Yeah. They want the home right in the beginning.
Yeah. I mean, I tell everybody it's like they're just married. They're buying as if they have two kids. They all want the 3-bedroom, 2 house. They don't even have kids yet. Yeah.
I actually talked to a lady at a luncheon yesterday, and she is just her and her husband. They want a 4-bedroom, 3-bath. Just her and her husband.
I mean, I've gone the other way. Mark may have done it. I mean, we scaled down when we moved from Colorado. We moved from the 3,000 square foot 3-car garage. It's just the two of us now. Our daughter's out of college, and yeah, we don't
Well,
need
I think
house.
Ivory's been to my house, but it's 1,090 square feet, 2-bedroom, 1-bath. Okay. Downtown Vancouver. It's me, Melissa, and 3 cats.
Yeah.
And you know what? It's just perfect. I don't need all the other stuff.
Yeah.
We laugh because we have a 2-office, 1-bedroom house. Yeah.
Yeah.
I like it.
That's hilarious.
That's my kind of house.
But it's like 1,100 square feet. Yeah. I mean, it's not big. Yeah.
Yeah. Yeah. I mean, essentially,
To put it in perspective,
Yeah.
though, so
Mhm.
we're talking about, home ownership being a foundation or a cornerstone to somebody's financial future, let's just say, right?
right.
So I bought this house, closed on it December 19th of 2019. And after all the dust settled with a bunch of, requests for repairs and discounts and stuff like that, I got it for $276,000.
Oh, man.
Okay. And I'm right over by the fire department on Main Street in downtown. Okay. And so I comp it out every couple of months just because I'm a real estate agent. That's what we do, right?
Mhm.
And last time I comped it out, it came out at like $457,000.
Yeah.
Now, I wouldn't pay that for it, but I'm sitting there going, it was a stroke of luck. You can't like time the market. But either way, anybody who bought back during that period of time, they're doing really well for themselves, at least in their real estate, as long as they're paying their bills.
Yep.
So,
Well, and if we can get more people to be able to take those actions and not wait because of their credit, I mean, so many more people are going to be in better positions in life. I mean, they're setting themselves up so well. Think of all the people who didn't buy, a year, 2 years ago, and what it looks like now. They've lost
Right.
out. And essentially what we're hoping to do is take people in these categories and bump them up, right? Whether they're in near prime, getting them to prime, or subprime, getting them to near prime. I mean, the whole idea is give them more of an opportunity to make that a reality, right?
sure.
So
Those people who 2021 made a lot of millionaires. They were property owners, and so millionaires in assets of property. So it's a gift that we need to help as many people get as possible, in my opinion.
And so what we're probably going to be seeing is these younger borrowers, because most of the borrowers we had before were in the older generations. They're staying put, unless they're planning on downsizing or unless there's relocation, right? There's always the one-off scenarios. But a lot of these younger borrowers, based on the data we looked at, are likely to be not in the greatest categories when it comes to their credit. So if we can get them on the path to a bit higher of a score, even just that little bit, right? Just getting them into the 600s, or high sixes, bump them up in the categories, we're giving them that opportunity. And I think we really already covered this.
Yeah.
Basically, that's what I just said right now. Let's help the younger generations be able to set themselves up for success. And what's going to be really important is everything that's happening now with all that data, with the delinquencies, people starting to go further past due and more past due on their auto loans and everything, it's impacting people for the next 7 years. Negative information stays on the credit report for 7 years. So delinquencies from January 2024 that we just looked at, they're there until 2031, unless they get removed, right? So having the delinquency can prevent them from getting to prime credit, and it's definitely going to prevent them from getting to the super prime credit. So the whole point of why we're here is to discuss how are we going to bridge that gap. So first we have to understand the why, right? What's driving the credit scores for all of us and for your clients. So whether you're looking at a Vantage score, whether you're looking at a FICO score, these are the main components: payment history, how much you owe or utilization, the length of your credit history, so what's your credit age, new credit and inquiries, and then lastly, credit mix, which is really just looking at your blend of the different types of accounts, right? Mortgages versus credit cards versus auto loans, personal loans, etc. That's credit mix. Ali, I'll let you explain a little bit about this slide just because I've talked so much up until this point.
Yeah, I'm just gonna basically breeze through this because I think it's
Yeah.
pretty much concepts of us in the lending industry are aware of. But obviously, number one, the biggest category to your credit score is, do you pay things on time? You know, if you don't, you're gonna have a lower score, period, right? Amounts owed is that utilization. And this is important when we talk about credit cards, right? And you know, Mark, we were talking about fluctuation in the credit card balances and things like that. That's a factor with credit utilization. So the lower your using of those credit cards, the higher the credit score. The more you use, the lower the credit score, right? So credit utilization has a pretty big impact to your credit score. Length of credit history, I think this one a lot of people forget about, or maybe just don't really quite understand it. Okay, you're chatting with me at the same time. You messed me up. So length of credit history is important, and I think it's often forgotten about. But when we talk about people who have those super prime credit scores, it's likely due to obviously good payment history, credit utilization low, but a lot of it has to do with a length of credit history. So how long have you had credit? And the only point that I want to make here is that the longer you have a credit card open, because it's the only thing that can stay open indefinitely if you do right by it, the longer you have a credit card, the longer the age of your credit history, the better your credit score. So when we talk about people who are our Gen Zs and all them, they're not going to have as long of a length of credit history because they're young, right? So they're already at a disadvantage for that. So getting to those credit scores, when we say super prime, that's when you have a lot of long history. So typically our older generations would have that.
But and it's only on your open accounts, right? Not your closed accounts.
Only your open accounts. And that's why credit cards are so pivotal. You have to have them. You just have to have them if you want to get into that super prime, which I hope everybody wants to get there. I call it the red carpet credit, VIP, everything, right? But length of credit history is really important. So I'll give you just one quick example. People call me all the time. They're so happy they paid their auto loan off, and they find out they dropped their credit score because it affected their length of credit history because it was their longest open account. They paid it off. Great financially, not good credit wise, right? So credit cards are really, really important. New credit, obviously, when you're getting credit pulled, has something to do with it. It also can affect your credit history, your age, your average age. So you have to be careful about getting new credit. Credit mix is having, showing that you can pay an installment loan, showing that you can pay a credit card, things like that. would be your credit mix. But again, I think often forgotten is that link to credit history, how important it is.
You know, I'll throw this out there just as an example because I'd love to hear your feedback. I just saw a really interesting one. I did this last week. Okay.
Mhm.
And just using the analytics with adding a secured credit card.
Mhm.
Okay. So the client had a bankruptcy, so it hides a lot of payment history. He had one account prior that I could see. I could see an old car loan on there. Okay. But what happened was in trying to open up the new installment, one of the scores went from he had no scores is going to jump to over 700. Okay. And so that was, and what the problem was, his car only reported to one bureau.
Mm.
So that one jumps to 700 in 1 month's time. The other two, it's going to take me 7 months to get a score.
Yeah.
So that lack of credit history is just killing them.
Mhm.
Yeah, he was
Yeah.
lucky with the one showing that he did have an auto at some point in time, because if you had one at some point in time more recently, then that'll allow that. You won't have that 6-month wait period that you
Right.
currently have with the other two. Yeah.
Yeah, so you have to have 6 months of history for the score to populate.
For a mortgage, right?
Yeah,
Like
right.
when he went to go buy a car today, he would have credit scores across all of them.
Okay,
So-
so run that by me again.
There's different algorithms, and they function slightly differently depending on what type of lending you're doing. So different FICO credit score algorithms.
But so like, if he went and got a car loan now, do you think that would change rather than the secured card, how quickly he'd have a score?
No, you'd still need to have 6 months of history.
Okay.
In general, but if like if you had an account that had been that's closed, but it's been active within the last 6 months, that's gonna, and you open a new account, you have some history that it can pull from. So if you have yeah, does that make sense?
Yeah. Yeah.
Now he might get mad at you because he goes somewhere else and he has scores across all three, and you're telling him he doesn't. So you have to just school him on that. The mortgage industry, to get that credit score, you do have to have that 6 months of credit history, which he doesn't.
Yeah, not another mortgage lender, just like another.
Right. Yep.
Mhm.
So that's a good point, though, that I do need to educate him. This is the mortgage model. Doesn't mean you won't get scores on another model, but this is the
Right.
mortgage model. Yeah.
Right.
Because the worst thing you could happen to you is that he's like, this guy told me something that's wrong. I'm going to go to a different lender because they're
Yep.
going to give me a score, and that's not true. But he's going to wait 6 months at some point in time, get one. He's still going to call you a liar if you didn't tell him. So, you know, but yeah, just different.
Yeah. Mark, just so you know, I work with a lot of bankruptcy clients. I have a bankruptcy attorney that refers me. And so I see a lot of people that have gone through bankruptcy.
Oh, really? Very good.
So we looked at the data, we looked at the basic components of your score. So now let's dive into the tips, the entire title of today's webinar. Now the tips we're going to look at are going to be focused on two things: battling delinquencies and battling debt to income ratios, right? Because those are going to be the major issues we're going to be facing. Typically, if you have a lower credit score, you're going to have higher debt to income. You're paying more for the debts that you have, right? Your interest rates are higher. Okay. So tip number one: removing derogatory information and finding errors, excuse my typo there. So derogatory accounts can also impact the debt to income ratio. How many times have you pulled credit and you've had to calculate a charged off account or, you know, a negative item into your debt to income ratio? So there's ways to approach it. One, you can get them removed. The way that I did not put down under there is settlements, pay them off. Anything you want to add there before we go into examples of the error side of things?
No.
Okay, pretty straightforward, right? Don't let the derogatory accounts crush your debt to income. Now, the other thing that you want to look at is the errors when it comes to credit reporting. What do we mean by errors? Our fun little picture here highlights some, but essentially it is the consumer's right to have an accurate credit report, okay? So it does not necessarily, for example, someone may have been past due on, let's say, their credit card in August 2020, for example. But let's say the credit report is showing them past due in September 2020. That's an error. That's inaccurate reporting. Or let's say Equifax shows correctly past due August 2020, but Experian and TransUnion say past due in September 2020. That's inconsistent, right? So any sort of inaccurate information can allow for a dispute to be filed and can allow for that information to be removed from the credit report. It's all about what those consumer rights are, which is to a fair and an accurate credit report. So there's a lot of different issues, a lot of different errors we can identify when it comes to credit reporting. Some of them are listed there on the screen. And all of that can cause you to get negative information removed from the credit report. And since, Greg, you see a lot of individuals who have come post bankruptcy, bankruptcies lead to tons of errors in credit reporting. So there's often a massive amount of opportunity to find inconsistent, inaccurate, or obsolete information on the credit report that can lead to removals of that negative information. So.
Including the bankruptcy.
Yeah, including the bankruptcy itself. And later on, we're going to dive more into the errors themselves and how they can be addressed. But this is more just, here's a tip. This is a huge one. Especially if you have a little bit of time for that borrower, for them to get ready to buy, maybe they actually came to you before they were ready, not after they wanted to buy 3 months ago.
Yeah. They came to you, they didn't just find the house that they had to have. Yeah, they have some time.
So, okay. So my big premise is it's never about whether you were past due or whether you did owe that collection, or whether the account was charged off. It's about, is there an error with the credit reporting? To be very clear, errors equal opportunities. Another thing to keep in mind, on the lender side, you see a tri-merge credit report, right? So you're not going to be able to identify the differences between the 3 credit bureaus. So, like on our end, for example, on my end and Allie's end, we are able to see the differences between all 3 credit bureaus. So we're going to be able to find those inaccuracies more readily than you will be able to see on your end because everything's merged. Okay. Tip number 2, fill the credit report with good information. Remember, we talked about all of these factors are influencing the credit score. Well, you can infuse a credit report with good things, right? With good information, help kind of, the right word is not hide, but diminish the impact of some of the negative information on that credit report. So if you have someone who may not be impacting one of those categories as much as they could be, you may see score improvements from that impact. So the top example here is utilizing authorized user accounts, and in parentheses, while you can, because we're seeing some changes to models being used in the mortgage industry already starting to happen a little bit, but over the next year or two, we're going to see some major changes that may take that option off your plate. But while it's an option, you might as well take advantage of it. So I understand sometimes underwriting may have issues with this. So this may be scenario by scenario basis, and Allie can talk a little bit more about that side of things. But when you have a borrower who is added as an authorized user on an account, all that payment history flows onto their credit report, right? So they're able to gain all that positive history. So sometimes we'll utilize it when we are rebuilding good credit and one spouse has excellent credit and the other spouse maybe has not so great credit. Allow them to piggyback off of their partner's credit and really infuse their credit report with good information. We've seen boosts of up to 100 points in 30 days just by utilizing that. So, I mean, that's kind of a quick win that can get you where you need to be.
And Greg, that might be, if it's a possibility for your client, that might be a solution to your current issue.
Mm-hmm. Yeah, absolutely. So utilizing credit building tools is another option. So this option is right now not as readily available as when the models in the mortgage industry are going to be changing. So once the models change, you are going to be able to use rent reporting, utility subscription service reporting, so many of these credit building tools that essentially infuse the credit report with good information. Especially for those with limited credit profiles, this can be extremely helpful. You have issues with someone not having 6 months of prior history. A lot of these are backward looking, right? So rent reporting will look 2 years in the past and pull that rent history on the report based on connecting their bank accounts. Utility bill subscription service reporting typically looks 6 months back. There's a couple different providers for that. So those will all be really quick win solutions, especially when that score model does change. Currently, right now, with FICO Classic, which is used in the mortgage lending space, those options don't really help the score. You're going to see them on the report, but they're not helping the score that you see.
Yep.
So just to be clear, anything you want to add on either of those, Allie?
I would add, so correct, rent reporting, utility reporting, things like that are not going to help the mortgage credit score. However, underwriters like to see rent reporting showing that they paid their rent on time for the last 12, 24 months. It can go back as much as 24 months. But I think the other important point to that is it does affect FICO 8. FICO 8 is the model that most other lenders use, if you're going to get a credit card and things like that. So if they're in a situation where all they're getting approved for is like secured credit cards and things like that, and they want to get a true regular credit card, adding these on there would be really good thing for them to go ahead and do before they start applying for credit cards.
Yeah, absolutely. Absolutely. And I mean, if they're also in a situation where, let's say it's 6 months, a year before they're actually planning on buying their, let's say they have an auto loan and the rate sucks on it. If they're utilizing some of these credit building tools, it may pull their scores up enough to where they can refinance that, get a lower rate. Now that's going to help their debt to income ratios, right? And the great thing about these tools is it's not adversely impacting their DTI, right? You can, oh my gosh, what's the word? Exclude. You can exclude the rent reporting, the utilities, right? All that from their debt to income ratios. So it's not going to hurt your loan application. Another great tool is credit builder accounts or credit builder loans. They're essentially savings accounts that report like loans on the credit report or like a reverse loan. So the borrower pays, typically most are anywhere from $5 on the low end. But most that we recommend start at $25 a month. And that's going to allow them to build a little bit of savings. At the end of the term, they get the money back plus the most negligible amount of interest. And now they were able to build credit and really impact that credit mix without having to take out a large amount of debt, right? So that can be really impactful for someone who, let's say, only has credit card history.
I don't know about that at all. This is a new introduction to me today.
Yeah, they're great. One of the programs that we like to use also, once they've saved $100, gives them a credit card that's secured based on their savings. So it's really a combination where they're able to both impact their credit on the loan side and the revolving debt side. So it's a really great tool that they can utilize and really get them used to establishing credit and then using a credit card responsibly at the same time.
What I love most about it is a savings account. And it's what I call forced savings, right? You got to make that payment. If it's $25, you're going to make that payment. But it starts to get these people into the mindset of saving money. Because I think in our current age, that's not something people do.
Yeah.
They're not saving money. They're getting the shiny thing, right? So this is a great way to introduce them to that. I like to call it forced savings. But then, if they need to have, maybe they get down payment assistance, but they still have to pay for their appraisal. I can't remember how many times a person couldn't come up with the funds for their appraisal, right? And this is a great way to start to have them save up money to be able to afford those things.
So this is, again, the reason I love this, it's something new. And Ivory, I know I've talked to you about it. Allie, you probably haven't heard it, but I'm really trying to get into workplaces, bring them financial wellness training. This would be a great thing to have a topic on. Yeah,
absolutely. They pick the dollar amount, savings dollar amount for their goal, and basically it reverse engineers from there. Well, this is how much you have to save each month and forces them to do it and builds their credit at the same time. So.
Yeah, I can see a lot of the, lower end income employees at a place that, that home ownership is a ways away, but this would be a great tool for them.
Absolutely. My last thing on here is just, I am not a fan of purchasing trade lines. It's completely legal for a consumer to purchase trade lines, to be clear. What's fraudulent is using that to then apply for debts. So, if you ever have a client that asks you if you can buy, if it makes sense for them to buy trade lines, just tell them no.
I'd never even heard that before. So yeah.
It's starting to, it rises and falls in popularity. And we're starting to see an upward tick, at least for people who call us asking about it. Essentially, you're buying access to put somebody else's credit on your credit report.
Okay.
So you're paying them to use it. And it is, oh, I missed some chats. It is completely legal to buy the trade lines. No, I never said it's okay, Rich. It is completely legal to buy trade lines. Technically, it's when they're utilized to apply for debt that makes it fraud. So this is why people can still get away with having companies where they buy and sell trade lines. So
let's make the point too. It's very expensive to buy trade lines.
yes. Oh my gosh. I mean, yeah.
And you only get the trade line on your credit report for a certain period of months, and then it's gone. So you'll have that good credit score temporarily, and you spend a lot to get that temporary. But I guess, it works for people who want to go buy a house real fast and don't care about what happens later, but I imagine those could be, Ivory says this is fraud. Some people say it's not. I tend to believe what Ivory's saying, just because I've been in the mortgage industry, and I would call that mortgage fraud. But people do it.
Yeah. It's argued back and forth if it's fraud or not, but there's some very clear boundaries that have been set on when it's fraud versus when it isn't. So, yeah. Anyway.
Well, I thought it was interesting when I was at a convention, the person who was selling trade lines didn't want to be interviewed.
Yep.
I was like,
I
that
know
might be
exactly what you're talking about.
that might be a telltale sign.
Okay, tip number 3, knowing what to pay down or to pay off. Super important. So what gives the highest boost dollar for dollar? I can't tell you how many times we've had people referred our way who just took everything they had and put it towards all the wrong things. And you're like, oh no, you could have saved so much money. You could have still had money in your pocket and paid only a few things. So let's not rush without a plan. I think that's my main premise. So knowing what impacts the score, the utilization ratio is super, super important. So let's talk about that first, credit cards. It's all about ratios, right? I got a $5,000 credit card that's maxed and a $500 credit card that's maxed, right? That's the limits. If they're both at 100%, they're both hurting my score the same. If they're both at 50%, they're hurting my score the same, right? So it makes much, much, much more sense to pay down the cards with the lowest credit limit first. You're going to get the biggest bang for your buck, the biggest score increase for your dollars, right? So always approach it in that manner. And it's important not to forget things like charged off credit cards. Those are impacting that credit utilization ratio as well. So paying those down, settling on those can also help the credit scores too. Paying a collection to $0 does not help the credit scores. Our exception is, Allie, you like talking about this.
Oh, I love it.
Our one and only exception to, she's spacing out fine. Our one and only exception to paying collections.
I would say there's 2 exceptions. Avery and I kind of fight on this one, but I think she agrees. She put this one on the slide. But the number 1, medical collections, once they're paid, immediately removed from the credit report. Nice score increase from that. Utilize pay for delete. So there's several collection companies, and it's kind of a new thing in the last few years, and I think it's going to become more and more widespread. But a lot of the collection companies will settle and then delete it from your credit report like it never happened. That's a beautiful thing. So she listed a couple of those. This is just a few of them, but LVMV funding, portfolio recovery, Midland. These are also the top ones. So like Midland
Right.
Funding is the
That's
number
why I
one.
put them.
Yeah, they're the number one largest in the world. Portfolio recovery following very closely. They they're easy to work with until they send it to their next spot, which is filing a judgment against you, and that's not pretty. So when I see these on people's credit report, I'm like, yes, this is great. We could settle and get it removed, but we better, because we're going to get a judgment if we don't. So
And I take the opposite approach. Give me proof first and then we'll pay, because who has also had lawsuits for not having proof?
yes,
All three of these.
yes, exactly. Never pay anything that's not proven. Yes.
Go
How
ahead.
do you, I mean, do you see agreements up front that they say they'll delete it if you pay it in full?
So this is their policies. So for these companies, and there's several others, I just picked the biggest collection companies you're most likely to see most frequently. It is in their policies. Midland, it's straight on their website. If a borrower went to their website, it says on there, if you pay it off, it will be deleted. So I still recommend, if you're going to instruct a borrower to pay, to make sure that they're offering settle for less would be ideal. I would never tell a borrower to pay 100% on a collection. This is the only philosophy, I'll say this, that Allie and I have any disagreements on it are collections. So you can watch us bicker back and forth a little bit about it. We're both right.
We're thinking about doing a debate.
Yeah, we are thinking about doing a debate on collections.
That'll be a fun one. That'll be a fun.
Yeah. But essentially, my rule of thought is don't rush to pay anything if you have the time. If you do not have the time, it's a completely different conversation from my perspective. And we have several clients who it's like, hey, we don't have the time. We're going to be kicked out of the house. The house is being sold. We got to find a new place. Okay, we don't have the time to worry about it. You have the funds available. Let's do pay for deletes on everything we can, right? But most collection companies will settle for less. I always tell people, if you're going to call, and you have some time, wait till the end of the month, because they're all trying to hit their numbers that they need to meet. So my recommendation, last week of the month, you tend to get a little bit more leeway on the amount that you're paying. I also recommend, this is just me, because I used to do collections for a little while, fun little stint way back when I first started. But also, if you ask for the supervisor in the nicest way possible, not being a jerk and getting a supervisor, because you want to get a lower dollar amount, sometimes they'll give you a little bit more of a steep discount because they get a little bit more leeway with what they can do. It's not going to be everywhere, but at some places you can get a little more there. So if you got limited funds that they're working with, that may be a good way to go about it if you have a lot of things you're trying to settle on.
But if you can, always dispute first. Always.
Absolutely. See, we do agree on things.
Make sure you get a chain of title. If so, I had a girl, she got a letter in the mail from some mysterious credit collection company that I have never heard of. I'm like, we're not paying that. It's a great settlement offer, but we're not paying that. This company is wrong.
That's a good point. Have you been seeing, Ali, we've been seeing a lot of scam companies lately, where they're not real collection agencies.
Yeah, so this is the time of the year people need to be especially careful. It is tax refund season, so there's advantages with tax refund season. You will get better settlements for most companies this time of year than any time. I am a debt settlement expert. I'll give you an example. We had a auto repo at $16,500 settle for $2,000. It was 2 years old. Okay. But that's the time of the year. Now, I wouldn't have got that in November. Okay.
Wow.
But they feel like this is the time that they can get paid because people are getting tax refunds, right? What was my other point of that? So there's that. And then you said something else, Ivory, about the debts, and it made me think of two things that I wanted to point out about that, but maybe I just forgot.
I don't know.
I could come back to it if I think of it.
It'll happen. It'll come back. I mean, ideally, so if the opportunity arises and we find issues to where they don't have the proper proof, I mean, debts can be canceled essentially. Those collection agencies will no longer report it to the bureaus. They'll stop collecting on it. Last year we were able to do that with over $1,158,000 in debt. So That is why I say, hey, if we have the time, let's go that route. We don't always have the time. Settling on charge-offs, I do want to go back to that. Another important reason it makes sense to settle on those if they're not too old. That's the other thing, Allie, we should talk about re-aging and obsolete timing. But with charge-offs, if you can prevent them from being sold to a collection agency, you're going to prevent that client's credit report from being hit twice, once from the original creditor and then again from the collection agency. So that's important that we can prevent that. And also, of course, preventing judgments as well if you're taking care of it. One other thing that some collection agencies will do, and why we do like to ask for that documentation, is if they're re-aging the debt. If the debt is too old to still be reporting, that's an issue, right? It should not be on the credit report if it's over 7 years old. So, did I spark your memory at all?
Yeah, you did. And then I was thinking, man, there's so much about this particular topic that we can go into a whole another hour conversation, but there's just a lot when it comes to collections and settlements and all that. I get the point is you got these opportunities to settle debt at a lot less than you ever can any other time of the year because of the tax refund season. But the other part is the spam rate, the hackers people are getting their checking accounts hacked. They're getting calls from people saying, oh, you owe me. And they will have the details. They'll say, you owe US Bank from this date. Here's your social security. Like they have that. They stole this information, but they sound good. And people will pay them. And because they're like, oh, we're going to send a police officer to arrest you for fraud, so it's scare tactics and things like that. So it's a really scary time of year for a lot of people who could get scammed.
Right. And we are seeing a lot of it happen. We're very grateful that, people are calling us first before taking action in many cases, but they don't always. And then just remember medical collections with the law change that happened a couple years back. Once a medical collection is paid, it will be removed from the credit report. So that is a policy change that the Bureau's implemented. So that's not any change with credit reporting or anything like that when it comes to algorithms. That's purely something put in place by Equifax, Experian, and TransUnion.
So I just wanted to recognize the time. It is 6:06 Eastern Standard Time. So I know we're on number 4, so maybe we can speed up because I want to respect everyone's time today.
Yeah, so number 4, dealing with student loans, make sure you are getting those income-driven repayment plans, having them really look at getting their plans figured out. I guess that's as simple as it is. No need to unnecessarily calculate too high of debt to income ratio. That's really the whole point of this. Know what programs are available for discharge as well. There's been several instances where we've spoken with loan officers and we've been able to help walk the borrower through the necessary paperwork. And then if they are in default, they can be pulled out of default. I'll leave it at that.
Yeah, very, very easy to get student loans out of default right now. Super, super easy. Great programs called the Fresh Start program. And then everyone who can qualify for the state program should be doing that today if they're not already on that. That does in essence stop the interest from growing above the original loan amount, which has been a big problem for a lot of people.
And then number 5 is don't forget about stale cards. So 53% of credit cards are active right now, right? We talked about that. So stale credit cards are going to be the ones that aren't influencing the credit score. Remember, if you haven't used an account, it doesn't impact the credit score, even if it's an open account. So you may be able to see score boosts for your client just by them using a card that they haven't used in 3 months or 6 months, right? So this is just a don't forget about the things that can positively impact you, not just focusing on what's negatively impacting scores. So, okay, so how can we help you achieve all these tips and solve the issues that we looked at before? And we're going to just speed through this because apparently we're super long-winded today. So Allie and I mentioned at the very beginning that we had band together and created Credit Score Pro. So I don't know why I don't have the entry title, but that's fine. So Credit Score Pro is our software that is going to automatically analyze the raw data credit file. So you see a credit report. The vendor allows you to see only the information they want you to see. On the back end, there's a whole bunch of code and information that Allie is an expert at analyzing and reading, and that is how all this technology has been developed. So we had mentioned earlier, tip number 1, errors, finding those errors. The AI looks at that code and finds errors we can't see with the human eye. So it's going to find way more than what we recognize when we all see a credit report, right? That's the key. So it creates way more opportunities for disputes, which means more opportunities for removing negative information from the credit report. So I'll leave it at that. The way the system is structured is once the user signs up, they set up credit monitoring through our partner Smart Credit. It automatically analyzes the credit report. It's going to identify what accounts are positive, what accounts are negative, and then the user does have to decide on their end what accounts they would like to dispute. So they will choose the accounts. Okay, and then from there, because we mentioned our AI knows what to do, it knows the proper disputes. Based on every prior user that's used the platform, it's learned what works, what doesn't work, and it's constantly learning. It's fully machine learning, right? And it's going to determine the most appropriate dispute based on success rates and everything else I mentioned. I'm trying to talk fast. So after it creates the disputes for one bureau for each of the accounts, it's going to automatically move on to the next credit bureau, right? So they'll look at all 3 credit bureaus. And then from there, and Rich, this was one of your questions, how should we be sending disputes out? We recommend mailing all disputes, not using it online, not some people even fax, and some people even email. You have all your rights. You're more protected when it comes to mailing disputes. We're going to leave it at that. There's actual reason behind that have to do with your consumer protections, but everything through the mail, that is the necessity. Our system does allow, if the user does not want to print and mail the disputes themselves, they can click the button, don't have a printer, and it will allow them to use our third-party mail service. Once they make a dispute, it is emailed to them as well as they can download it. So we do make sure that they have a hold of it. Let's see. Anything you want to add on that, Allie, as I ran through it super fast? I just want to make sure I didn't forget anything.
You were talking about mailing the letters. I highly recommend that the person prints and mails the letters themselves. Of course, we do have an Dash available to people who are not able to. But if you want to get the full benefits and get things done faster, you are going to be better off if you print those, you handwrite your signature on them, you fill out that envelope, put a stamp on it in the city and state that you live in. The credit bureaus have a computer system that actually analyzes all of that to see if it checks the boxes. And if it doesn't, they will oftentimes hit a button that they call the ignore button. And that, well, they don't call it the ignore button. They probably have a really jazzy name for it.
We call it the ignore button.
We call it the ignore button because essentially that person gets a letter and says, hey, we received your dispute letter, but unfortunately, we don't believe you sent it, so we're going to ignore it. That's the letter they get back. So this makes that process, mailing it, putting your identification documents in with it, especially the first set of, I highly recommend it. But again, we do have Mail Dash available if the person needs that.
So Credit Score Pro is not just about negative accounts. We looked before why, we looked at a whole bunch of other reasons that impact the credit score, right? I'm trying to talk fast, so my mind's blank a little bit, but there's way more than disputes to increase your credit score, right? We want to influence every factor that creates the credit score algorithm. So it's all about how do we optimize what's working well, meaning how do we get more points out of it? And how do we fill in the gaps where we're not impacting the credit score algorithm? And that's really what our AI wants to do for the user. The great thing is that we talked about there's different models, right? If you're getting a home, that's one type of credit score model. If you're trying to get a car, that's another type, etc. So the users are going to pick what their credit score goal is, and then the AI is going to craft a credit action plan specifically tailored towards that model. So this isn't going to be like what you're used to with Wayfinder or the simulator tools. This actually is utilizing the algorithm to determine what makes the most sense, looking at also what is not on the credit report. No simulator tool used within the mortgage industry is as comprehensive as this tool. And then the great thing is if a user forgets to put in their goal, we're automatically going to craft an action plan for them as well. So it's going to be based on a general action plan to improve their credit. It's going to influence all the algorithms in a positive way. It's just not necessarily going to be as pinpointed as if they choose a mortgage, right? They can change their goals as often as they want, rerun this plan as often as they want. Every month when we get a new when we get a new credit report, it's going to automatically rerun this. So if they've completed steps, the next most important tasks are highlighted. Miss anything?
No, do a great job.
Okay. Credit building tools. So we do also offer credit building tools. The action plan is going to suggest the credit building tools that are pertinent to them. Based on the algorithm, again, they can be found just directly on our website as well. So if people do just want access to credit building tools, they can find them there. And then lastly, one of the other extremely important factors that we wanted to make sure we combated is lack of financial literacy. There's not really any education anyone can go find when it comes to credit. Even those in the banking side of things and the lending side of things, there's no holistic training on credit. It's not in school. So we wanted to make sure we created a resource for that as well. So while the users are working on not only improving their credit, but also maintaining their credit, even after all that credit damage is gone, they can also learn how credit works and understand the differences between the algorithms. We have a section in there that dispels common myths that you tend to see on social media. And then it teaches them how to read their credit report, has examples of different types of credit profiles, and then even goes into establishing and reestablishing their credit scores, which really ties into their credit action plan. So that is what Credit Score Pro is. And the whole idea is to make it so they did not have to be the expert themselves, right? They're given a system that allows them to have access to every single resource. And the great thing is they don't have to pay tons and tons and tons of money to a credit repair company or to any other type of expert. And which is one of the problems we've seen in the industry in general is either not having the funds available or not finding a competent professional to help. Anything you want to add, Allie?
No, that was great.
Okay, we're done. That's our Q&A. But if you do want to utilize Credit Score Pro yourself or sign up to be a partner with Credit Score Pro, we do work with mortgage companies, nonprofits, real estate agents. You certainly can utilize this for your client base or yourself. And then we do also have a Facebook group that you can join. We would love to have more professionals in there. So when people ask questions about mortgages or buying a house, etc., you can answer those questions because we can't. So that's that.
Thank you, guys. Thank everyone for being here. We appreciate it. We did get some people wanting to know, like, if they can have the recording. So Ivory, I think you always send the recording out. Obviously, you can rewatch it on Facebook, YouTube, and the different sites that we have it on. Cost. They only paid for the credit monitoring. We do not charge for our AI software. So the credit monitoring fee is $39.99 a month. And there's a lot of things they get with the credit monitoring. We partnered with Smart Credit Monitoring. And with that, they get a $1 million insurance policy against identity theft, which I think everybody should have right now. You also get Privacy Master. So that's constantly looking at the web and the dark web to see where your information is being sold. Through Smart Credit, you can take action to have your information removed from those sites. There's just a plethora of stuff that Smart Credit gives you. Credit scores, the monitoring, all that, the notifications. And then with that, you get our service for free. So $39.99 for the consumer per month. That was a question from Rich.
Any other questions we haven't covered either through the YouTube or Facebook? I think I tried to tackle most of them throughout. Hopefully I didn't miss
I did not get any off of Facebook. That's the one I've been watching, so.
Okay. Okay. Well, I think we'll wrap it up because we are very much over on our time today. We will be back again. Let me pull up what next Thursday's is and I'll stop sharing my screen. Let's see. Next Thursday, we will be oh my gosh, hold on. I do this every time. I should just have it up and ready to go. Okay. Next Thursday, our event is Credit Score Pro AI transforming your credit with artificial intelligence. So we're really just deep diving into the AI and the functionality of the AI and how it works. And
Oh,
then what?
I said
That
that
sounds
sounds
boring.
boring.
Oh, yeah, we'll be exploring AI in general in and how it's being utilized within credit and then within the lending space too. So it's going to go beyond just our technology. But we just definitely wanted to do a deep dive on that. So next week is a perspective of that for consumers. The following week on March 14th is the perspective for the lending space. And then the next lending webinar will be March 28th, Mastering Credit Reports. So that's really going to be a focus of reading credit reports, interpreting, utilizing them from the lender's perspective. So otherwise, the rest are all on our Facebook. So check it out there, Credit Score Pro. I thought there was an AI, but it's just Credit Score Pro. So okay, bye guys.
Should have been AI.
I know, I'm like, maybe I should add that.
Yeah.
Whatever. Okay, that's it for today. We will unless you had any questions. Good to see your face, Brett.
Yes, yes. All right, guys. Thank you.
Bye.
Bye.
That was my only statement, was that you should do like a family plan for like parents.
Oh, yeah.
Keeping an eye on their kids' credit so they're not getting whatever the is. And that way their kids' identities aren't being stolen. Credit being
And that unfortunately, that happens.
Yeah, it does.
Parents do it to their kids sometimes, even. That's a big thing.
Yeah, unfortunately, we've seen a lot of that we've had to work on.
Yeah, I have to.
Yeah.
I had a parent, she spent 15 years in federal prison for doing it to her son, both her sons.
Yeah, we had something similar. It wasn't 15, it was 10 years, so.
Yeah. She was getting student loans out in her kids' names. And she had a whole nother family, husband and everything, you know, like not a husband, but yeah, a whole nother family and kids that she was using the money on.
Wow.
Yeah.
That's insane.
Wow.
Yeah.
That'd be good for both parents to know.
Yeah.
Keep an eye on it.
Good point.
Yeah.
Okay. So if I want my friend to do this Credit Score Pro and it's $39, is there like an initial $250 fee or something like that, or is it just $39 a month?
Nope. Just
Can I put it on my
$39.
Can I put it on my credit card?
Mm-hmm. You can. You on the billing information section, you just put your card details. Just keep in mind, if they have the login, they may be able to see. Does it X out the card number or?
X outs the card number, but
Okay.
you know, unless you're giving privilege, you know, you've got privilege to that login, you know, you don't have the ability to control if you're going to cancel it or not. They have the ability, you know what I mean? So,
Keep that in mind.
yeah.
That'll be a tool for her to, because she's on a fixed income,
Oh,
but
yeah.
got a lot of equity. So she's basically got about $750,000, $800,000 for equity.
Mhm.
So to